Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise, and I have a question for you. How much does the fear of the next market crash keep you up at night? If you're like most investors, you've probably had at least a few sleepless nights somewhere in there, but not Jaspreet Singh. This DIY investor sleeps like a baby. And that's because market downturns don't have to be the stuff of nightmares. Instead, they can be powerful wealth-building opportunities. So we're going to get a glimpse inside Jaspreet's playbook for investing during market crashes, recessions, and bubbles, and we're going to hear what he thinks the next big opportunities may be in the year ahead. And plus, make sure to stick around to the end of our conversation because Jaspreet's going to be answering your questions about investing during our live Q&A session, so stay tuned for that. But without further ado, let's get into it. Joining us is Jaspreet Singh, founder of The Minority Mindset, an investing education YouTube channel with over 2 million subscribers. He's also the CEO of Briefs Media, which offers newsletters, education, and stock market research for investors. Jaspreet, great to have you with us. Thank you for taking the time. I know you're a busy guy, so we really appreciate you taking time for us.
Well, thank you for the beautiful introduction. Thank you for the opportunity. It's really an honor to be on. I appreciate it.
I'm always humbled when I speak to people as accomplished as yourself, just running around doing YouTube, all kinds of social media. You're running a financial media company. How do you make time for it all?
Well, number one, I have a really good team. Number two, I have a very understanding wife. And number three, I don't think I sleep too much. So I think that combination together allows me to kind of manage a lot of different things.
Yeah, certainly having the supportive spouse is a big one. I can attest to that as well. And I really want to kind of dive into our conversation at hand here, but I want to know a little bit more about you. For those in our audience maybe who aren't as familiar with you, you're this creative force behind one of the most popular investing channels on YouTube. And I'm curious, what inspired you to get involved with YouTube and investing education content? And kind of give us some light on what the minority mindset is that you're really trying to convey to investors that you feel can help them build wealth over the long term.
Yeah, sure. So, I mean, I had I guess a unique journey to get here. My family is from a state in India called Punjab. And I grew up in a very traditional Indian house, which means when I was growing up, my parents gave me two career options. They said, Jaspreet, you can either be a doctor or I could be a failure. It's really my choice what I want to do. And I wanted to become successful because I saw how hard my parents were working and I wanted to give back to them. So I said, okay, I'll be a doctor. So during my entire grade school career, I thought I was going to be a doctor, but I was always doing these side like entrepreneurial ventures. Started off playing the Indian drum called the Tol at Indian weddings when I was in middle school and high school. And then when I was 16 in high school, a DJ that I was working with asked me if I'd like to co-host a teen party. And I said, sure. And I was kind of dabbling in entrepreneurship in secret because if my parents knew that I was doing these things, they'd be very upset. But I always had fun doing it. And then when I went to college, I was like, all right, it's time to buckle down, become a doctor and, do all the right stuff so I can become successful. But I realized when I got to college very quickly that people go to college to party a lot, more than just study and spend time in the chemistry lab, which I had no idea about. Like I didn't know anybody that went to university here, so it was a big shock to me. And that was when I needed something to do on Friday nights because I don't drink. I'm not into that party scene. Yeah, I was working at them, but I was looking at it from a business perspective. And so then I started taking my teen party business into college, and I started promoting and hosting parties in college. Well, now I started making a little bit of money. And again, I'm doing this all in secret. And I start reading books about money management and investing. And I start learning about this concept of investing, which I had never heard of before. Like I never knew about the word asset. I had never heard the term liability. I didn't know the term entrepreneurship. These were all words that I started reading in books. And it opened my mind to this whole new world that I didn't know that existed. I didn't know what a dividend was. I didn't know what a rental property was. It was shocking to me. And so at first I got very angry. I was like, I'm doing so good in school. I studied so hard thinking that I'm going to become successful. When in reality, there's this whole world of financial education, investor education that I had never been told about. And so that was when I started dabbling into investing. And this was after the 2008 financial crisis. The whole real estate market, stock market in the United States, I mean, it crashed, it crumbled. And I didn't really know what that meant because, I was young and I had now some money in the bank. And all the books that I'm reading talk about how wealthy people own real estate. They invest in real estate. I don't know that was how that worked, but I decided to do it. So I was 19, and I went out and bought my first rental property with the cash that I had in my bank. I bought a 1,000 square foot condo out of foreclosure. It was previously sold for a little bit over $150,000. Went through foreclosures and just couldn't be sold. And with the state of the market, it was listed on sale for $8,400. I ended up buying it for $8,000 flat. I put in a few $1,000s worth of work to renovate the condo, and then I rented it out for $600 a month. And now all of a sudden, I had turned this cash in my bank, which normally I would have used to buy a new watch or upgrade my car or buy something stupid. I turned into an asset, which was now paying me with cash flow. Now, I made a lot of mistakes. I mean, I screwed up so much. I can't even, this could be another 3-hour discussion on my screw ups. But what I learned was if I take this money that I'm earning and buy this asset as opposed to buying something stupid like a watch, I can turn this money into more money or into cash flow. And that was very new to me. And so I knew that was something that was interesting and fun and really novel for me. And so I continued down the entrepreneurship route, realized that I didn't want to be a doctor, told my parents that I didn't want to be a doctor. They really were not happy. It took my mom about a year and a half to actually believe that her son was not going to be a doctor. And so my dad made a compromise with me. He said, Jaspreet, if you want to keep any pride in the family, you have to at least become an attorney. I said, okay, I can do that. So I went to law school part-time and running my business full-time. And I had also, I worked on a lot of different businesses because it was fun for me. Entrepreneurship is really fun for me. Coming up with business ideas was fun. I did not mind working a lot. It was fun. And so I went from business idea to business idea to business idea just because I didn't know what to do. I didn't know how things worked, and I just tried them. There was really no concept of risk in my brain because I was like, I have nothing to lose. And I ended up built a sock company. It was a water-resistant athletic sock that you could wear when you're playing football or soccer or whatever to keep your feet drier when you are playing in the rain. And I spent a ton of time trying to build it with very little money because I didn't have a ton of money to invest in it. But anyways, I go to launch this business, and I had hired this marketing company who had promised me all these big promises. I gave them pretty much all of my marketing budget. They run away with the money. I never heard from them again. We launched the business. My goal was to do $10,000 of pre-orders in the first 30 days. We ended up doing over $21,000 of pre-orders in the first 30 days. And now we're in business. Business is good, but I'm still frustrated because I have been screwed over so many times now. I made so many mistakes when I was investing in real estate. I made so many mistakes when I was starting the party promotion business. I made now this mistake of just hiring the wrong person. I was so frustrated that I then decided to start creating content under the alias Minority Mindset, where I could just talk about the things that I wish somebody would have told me when I was younger. And the whole idea behind the minority mindset is not the way you look or your ethnicity or your skin color. It's thinking differently than the majority of people. Because that was me. I was that person that thought if I just did good in school, got good grades, everything is going to be fine. I just got to trust what everyone's telling me. When in reality, the people that actually build real financial wealth are the people that do something different. And that really bugged me so much that I started calling it that minority mindset, that you have to stop being like the majority of people, because the reality is the majority of people are broke, unhappy, fat, and a lot of them are drowning in debt. And so if you want to do something different, you can't keep doing what the majority of people do. So that was where the name Minority Mindset came up. And so I started publishing content and started making YouTube videos. I didn't do it with the intention of making money because I was running now my sock business and I was running my real estate business, and that was taking most of my time, and they were doing well financially. And I remember I had grown to somewhere between 10 to 30,000 subscribers. I don't remember the exact amount. And my friend asks me, Jaspreet, how much money are you making on your YouTube channel? And bear in mind, this is before YouTube had any monetization requirements. So you could start making money and running ads with 0 subscribers, with 0 views. And I was like, what are you talking about? He's like, how much are you making from ads on YouTube? I don't know. I'm not making any money from ads. So he goes into my back end. He says, Jaspreet, if you click this button right here, your ads are going to turn on and you can start making money from these videos. So, it really started as a hobby, just as a way for me to talk about the things that I wish somebody would have told me. And also because my friends also kind of got bored of me always talking about this stuff with them. So it was like an outlet for me. And I've been very fortunate to see the channel grow to what it is today. Now Minority Mindset, like you said, has over 2 million subscribers, which is still mind-boggling to believe that there are millions of people that have actually subscribed to the channel, and that also helped birth now what I do full-time, which is running Briefs Media, like you mentioned, which is a financial media company where we publish things like our free financial newsletter called Market Briefs, and we have a whole bunch of other financial research products as well. So that's kind of the journey in a nutshell.
Well, certainly, I think it can be said, people vote with their feet. And I think it's no coincidence that your YouTube channel has amassed as many subscribers as it has and many dedicated viewers. And the same for Briefs Media. The newsletters are great. So I want to talk about applying that minority mindset, how you've done that to build your wealth from market crashes, bubbles, recessions, all the things that terrify investors that can actually be fantastic opportunities. I just want to give people a quick note in the audience there. You can submit any questions or comments you have for Jaspreet using that question and answer box on the right side of your screen there. If you're joining us on our YouTube live stream, you can follow the link in the description. It'll let you hop into the broadcast platform here, and then you can join in on the conversation. And just another quick note I want to throw out there, just be aware that we're talking about Jaspreet's approach to investing during turbulent markets based on kind of what works for him, but every investor is unique with unique financial goals, needs, and risk tolerance and what have you. So kind of take the conversation that we're having here as food for thought rather than any kind of explicit financial advice. But with all that said, let's get into it. Jaspreet, let's get right to the goods here. I mean, most investors, like I said, are terrified of these events like economic recessions and market corrections, bear markets, asset bubbles popping, what have you. Yet you see them as potential opportunities for building long-term wealth. So make the case for us. Why is that?
Yeah, well, I was very fortunate that I started investing in the worst of times after the 2008 financial crisis. I remember I had a little bit of money and I bought Ford stock for $2 because it seemed kind of, I always wanted a Ford Mustang. But my dad wasn't going to let me have a Ford Mustang because whatever, it's a lot of money. Anyway, so I ended up taking, I don't remember how much it was, but it wasn't a lot, a few $100, and then bought Ford stock for $2. And then Ford stock started to rally and I realized, whoa, maybe I'm a genius investor, when in reality, not even close. It was that I got fortunate that, number one, I bought a company that didn't go bankrupt. And number two, I bought the company when it was very cheap. Now, I saw the same thing happen again with real estate. The real estate market after the 2008 financial crisis was decimated, and I started investing in real estate in 2011. I got so lucky with the timings because you could buy a house for sub $20,000, 3-bedroom, 1.5-bath house. And that's what I was doing. I thought that was normal. What I didn't realize is that this was a once in a lifetime opportunity. But what's interesting about that time is I talked to a lot of people about what I was doing because I was making money from a number of different places and then taking that money and buying real estate. And I knew multiple people that had more money, had more experience, were much more successful in business or whatever than I was. And when I would talk to people about investing in real estate, the common response that I got was, Jaspreet, you're an idiot. Why would you want to buy real estate? Real estate creates bankruptcies. Real estate creates foreclosures. Real estate creates headaches. Real estate creates problems. Real estate does not create wealth. And again, these are people that had way more money than I did, way more access than I did, way more experience than I did. But the common perception was you should be scared, not buying. Because a lot of people worry that things were going to come to an end in the economy. Well, we know that that wasn't the case. And that's when I started to become a little bit more of a financial history nerd, because I started studying what has happened in the past. And we could take a look at, the United States has seen 16 recessions in the last 100 years. We've seen about 25 market crashes. And by market crash, I mean more than a 25% pullback, 20% pullback in the last century. Yet the common thing that happens amongst each one of those is people get scared, they panic, they freak out, they sell, and then for whatever reason they say this time is different. This is not going to get better. This is going to be the end. Our economic system as we know it is done. And yes, there will be certain investments, if we're talking about stocks, that will fail. There will be certain companies that go bankrupt. But despite all the craziness over the last century, our economy has survived and thrived. Despite the 16 recessions, despite the 25 bear markets that we have seen over the last 100 years. During the 2020 pandemic, this was the first time that we really saw a real quote-unquote recession while I was in the media space. I was making YouTube videos. And so I really got to see a pulse of people's responses because I could see the comments live. And I was making videos every single day. So the pandemic hits, and markets are free falling, and the economy shuts down. I'm making videos every single day now. And in my videos, I talk about how I have no idea what's going to happen. If you picture March 2020, right? Nobody knew what the heck in the world was happening. All of a sudden, NBA games are stopping, flights are stopping, hotels are shut. Everything's just, it's confusing. And the sentiment at the time, which you all probably remember if you think back, is, oh my God, we're done for. The economic system is collapsing. It's who knows, uncertainty, it's scary. And so I was making videos talking about what's happening. And then I would say, I'm buying. I don't know what's going to happen. I have no idea what's going to happen. But if we just play out the scenarios, either we're all going to die or eventually we're going to recover, and markets will as well. Ultimately, those are the kind of two options that I'm seeing here. So I'm just going to keep buying. And we saw the fastest stock market sell-off in the history of time. We exceeded the pace of the Great Depression. We saw the fastest 30-some% sell-off in a matter of days. And what I did not expect, and remember, I run a financial media company. We do a lot of financial research. We study a lot of financial history. What I did not expect was the rate at which the Federal Reserve Bank was going to unleash stimulus, unleash the money printer, and pump up the value of markets. So we went from the fastest stock market sell-off in the history of time to the fastest stock market boom in the history of time. Both of those two things happened in the same year, in 2020. Now, the only way you can take advantage of that is if you are buying. Now, 2020 is a very unique recession. I even hesitate to call it a recession just because many people didn't really feel any economic pain. But the reality is recessions happen. They are a part of our economic system. They have happened in the past. Remember, we've seen 16 in the last century. They're going to continue happening in the future. And when they happen in the future, the question is, what side of the equation do you want to be on? The one that's panicking, freaking out, and being blindsided? Or on the side of people that's saying, all right, this is creating an opportunity. How can I come in and buy good investments at a discounted price? And this is where, again, I can't tell you what to do, but the definition of a good investment is going to vary. Somebody might say, well, I'm just going to buy the S&P 500 because that's the easy way for me to do it and I can diversify and reduce my risk. Somebody else might say, well, I want to buy this particular company because I believe that they're going to be the next Apple, Amazon, NVIDIA, whatever you want to say. But that's going to depend on your research. And if you're investing in individual companies, well, you're taking on more risk for more potential gain, but the company can also go bankrupt. If you're investing in the S&P 500, less risk, less potential gain.
So my thought there is what I'm hearing is that, when the market is crashing, everyone's panicking. It's kind of like that old Buffettism where, be fearful when others are greedy and greedy when others are fearful kind of thing. So you want to be ready to buy with the expectation that things are going to rebound because at least, history can give you some confidence that might happen. But I'm curious, what do you do in the lead up to a market crash or a recession or what have you? Is there anything you do specifically to prepare to be ready for these opportunities and pounce on them when they present themselves?
Yeah, you got to have access to money. To take advantage of an opportunity, you have to know the opportunity is there, then you have to have money to actually capitalize on it. And what I like to say, to keep it even simpler, is you have to understand POOP, P-O-O-P. Now you're going to say, what the heck is that? P-O-O-P stands for panic, leads to overselling, leads to opportunity, leads to profit. That's what you see in every downturn. Things start to go down because a bubble burst. If any bubble bursts, people panic because now they're over levered. They bought things they should have. They're losing money, so people panic, and that leads to then selling, which eventually leads to overselling. If you start to see the overselling, well, now you will see good assets, good investments that are selling for a big discount, which is that opportunity. So panic leads to overselling, leads to opportunity, and that opportunity you can only take advantage of if, number one, you're financially educated, number two, you have money to do that. And then that creates the opportunity for profit if you are patient. Because in 2020, markets turned around, in a matter of weeks. But generally, it doesn't happen that fast. Generally, it takes a couple of years. And so you have to be patient. And sometimes it could take a little bit longer, sometimes it could take a little bit less, but the idea is to be a long-term investor and to understand POOP. That way you can capitalize on those opportunities.
Yeah, Jaspreet, I have to admit, I have an 8-month-old at home, so when you said POOP, I thought of a very different type of POOP, not an acronym for investing. But that's words of wisdom there for sure. Now, you mentioned that, it often takes about an average of 2-ish years or so, if you look at history, at least for the U.S. markets, at least to bounce back. But there's also a pretty wide range of possibilities there. Like you mentioned, with the COVID crash was over and done with within like 6 months or something like that. But then if you look at, Great Depression and something like that, it took the Dow Jones Industrial Average something like 25 years to recover from that crash. So there's obviously a wide range of possibilities here. So a skeptic might say, pointing to something like the Great Depression or the S&P 500's lost decade that happened between 2000 and 2010 after the dot-com bubble burst there, to kind of challenge the idea that it's always a good idea to be investing and that, market crashes can be this great opportunity. What would you say to kind of counter that pushback?
Well, I would say you're right. But again, if you're investing for the long term, it is proven to win over the long term. The S&P 500 has averaged a little bit over 10% a year on average over the last century. So you might have to temper what your return expectations are, but it doesn't change what I'm looking for. If you believe that America, I'm in the United States, so I'm investing in the American economy. And if I believe that America is going to continue to be a strong economy in the next 100 years, then I want to be investing in the American economy. If I don't, then I want to find those companies or countries that I believe will grow. And, I have a number of different investments, but yeah, I have a passive strategy that I would always be buying no matter what, because I believe that the American economy is going to continue to grow. And if we go even beyond that, if we take this one step further, what we have seen over the last a little bit more than 15 years now is that the central banks in the United States have very much favored investors. What do I mean by that? Quantitative easing, stimulus, a lot of money printing to protect the interest of investors. Is that good or bad? Well, I'll let you decide. But the reality is that's what's happening. And that's just been kind of the case for a while. And all this stimulus, government spending, government deficit spending, all of these things are beneficial for investors. So I'm willing to take that risk.
Yeah, one of the interesting factoids that I've always been captivated by. And we actually have a chart here. It's called Rolling with the Punches. It talks about there's never been a 20-year period of negative returns for the S&P 500 index since 1926, which is really impressive if you think about it. So if you can maintain that long-term mindset, it really can help you out. There's another like little story that I heard really that I always found really powerful too. I don't know if you've heard this one, Jaspreet, but it's about Bob, the world's worst market timer, where he invests big chunks of money right before the start of every single crash. But if he held on, he still ends up with millions of dollars, something like 40 or 50 years later. So as long as you can keep that long-term mindset in there, you can probably be okay. Now, just going back to COVID there for a second, I just wanted to ask, like, if you could go back in time before the start of the pandemic crash, if you had 2020 vision for 2020, so to speak, how would you have invested differently?
I would have just dumped more money in. That's the only thing that I would have done. I mean, what I was doing during that time, or what I was doing during that time, was drip buying. I was buying in phases on the way down. If you remember, during that time, the circuit breaker kept breaking because of how fast the markets were falling. And so I would just deploy money every time I saw the markets fall by 5%, another 7%, another 10%. I would just keep buying in phases because no one knew how low it was going to go. And so, I would just buy. I wouldn't necessarily say cautiously. I was buying aggressively, but I was buying kind of cautiously in the sense that I want to make sure I have more ammo to continue buying as it goes lower. But like, nobody can time the bottom. But, I guess if I know when it's going to be the bottom, I would just buy more.
But are you keeping like a war chest of cash on the sidelines there waiting for those drops? Or is it kind of just business as usual? And then when you see a drop, you kind of try to scrape together a little bit more money to kind of double down, if you will?
Yeah, so, what I do, and I don't recommend what I do to anybody else, but I have two systems. Number one, I have an active investing system and a passive investing system. I like to systemize things. That's how my brain works. So for my passive investing system, I have a number of funds. So the S&P 500 and other types of funds that I want to invest in. Most of these are dividend-paying funds. A lot of them are dividend-paying funds. Every Wednesday, money leaves my checkings account. It's automatically invested into my funds, no matter what. This happens whether markets are up, down, raining, sunny, shiny, it doesn't matter. I keep that on always. The only time I would change this is if we do see a market crash, I would just increase how much money is being contributed every Wednesday. Then separately, I allocate money to be invested into the stock market, to be invested into real estate, and a little bit for more of my speculative investments. And so now, if I see an opportunity, it doesn't have to be a market crash. I don't have to wait for a market crash to invest, but I'll just wait for a good opportunity. And that could be in a booming market. It could be in a crashing market. It doesn't really matter. But I have money here that's waiting to be invested. So I'm always working to build that as well.
So the passive and the active, they can live together. We often think of them as, diametrically opposed, but they don't have to be, is what I'm hearing. An interesting bit of research that I came across that I kind of wanted to pick your brain on, because this is something that we hear people mention when they think about ways to profit from market crashes and what have you. It was an interesting research paper that showed that some of the high-ranking U.S. officials reportedly sold stocks just before that COVID market crash, and obviously got out at a high here. And then we also hear, other investors who try to copy the trades of, U.S. Government officials or high-ranking, insiders at companies or what have you, in hopes of kind of beating the market and staying ahead of the next crash, and basically timing the market in a more favorable way. What's your take on that strategy? Maybe not the particulars of those U.S. officials or anything in that case, but just in general, this idea of copying the trades of insiders as a good strategy. Is that something that you think is a viable strategy, and is it something that you do?
It's not something that I do. Could it be a viable strategy? Absolutely. I don't know much about it. If it works for you, it works for you. I guess test it. I don't want to tell you what to do, because you got to find what's right for you, and sometimes you need a little bit of luck as well. What I like to look for is shifts, a market shift more specifically. And what that means is I want to look for where the money is moving, not where the money has been. And this is kind of more of a universal investment strategy for me. Even when I invest in real estate, I want to find areas, neighborhoods, cities where money is moving to, where people are moving to, not where they were. In the stock market, I want to look for companies, industries where the money is moving to, not where the money was. That's my investing strategy. And if somebody can find a lot of ways, a way to make a lot of money by copying Nancy Pelosi's, investment portfolio, good for you. I've never done it or tried it myself, so I can't speak to that.
Mm-hmm. It's certainly hard to get that kind of insider information in a timely fashion too. So that's one of the caveats to this, of course. But anyway, let's move on to another market crash that I wanted to talk to you about. This one a little bit more recently. This was the down market of 2022. This was a particularly difficult one for a lot of investors because both stocks and bonds tumbled at the same time, which is exceedingly rare. It's something like 4 times that both of these asset classes have declined in the same year since like 1929, at least when we're talking about the US market here. So I'm curious, was there anything that you did habit-wise or any steps that you took that helped you build your wealth during this particularly unique and difficult market?
I just continued doing what I was doing, man. I don't have that sophisticated of a strategy. I look for good opportunities and I keep buying. The interesting thing about the 2022 pullback is when you talk to finance people about 2022, they'll tell you that it was a horrible period of time, that 2022 was such a rough market. But if you talk to the average person about 2022, they don't even know that something bad happened. And that's kind of the funny thing about 2022 is, yeah, it was rough for investors. It was rough for people in the market, but for everybody else, it didn't really matter. I was buying more real estate. I was buying stocks, and it ended up being a great year. But overall, just for me, sticking with the strategy, I would say that was one of the biggest lessons that I've learned over the last decade is come up with a strategy that works for the long term and then stick with it, because you're going to go through cycles. You're going to go through asset cycles, meaning stocks go up and down, and you're going to go through a lot of other just economic changes, which can make it very difficult for you to want to stick with your strategy, whatever that is. But if you have a good long-term strategy, well, then you'll be able to find the opportunity if you're willing to stay patient. So I think, it's just knowing what your strategy is. And for me, I have my passive strategy. I'm just buying every week. If markets are going down, great, I'm buying more. And for my active strategy, I'm just looking for good opportunities. I want to find good companies that I believe that are undervalued. And when markets go down, more companies become undervalued. And just having money to be able to deploy. So, it's the financial education of how do I systemize my money, which is step one, right? If you have credit card debt, pay that off first. Then if you don't have any emergency savings, build that first. Now you start putting money aside to save, to invest, that we're not spending all of your money. Once you do that, now you have money that's being put aside to invest. Now you start deciding, well, how do I want to invest? Do I just want to invest in ETFs and index funds? Fine. Do you want to invest in individual companies? Okay. Now you got to invest more time in your financial education and research, and your investor research. If you're investing in an index fund or ETFs, how do you analyze them? How do you study the expense ratio? How do you actually know what the holdings are and see if this is something you want to be invested in? If you want to invest in individual companies, do you know who the CEO is? Do you know what their moat is? Do you know how to read a 10K? Do you know how to analyze those numbers? Those are the questions that now you want to start learning how to do. Once you start learning how to do that, now it's just making some investments, making the mistakes, learning when you screw up, staying consistent, and keep doing that even when markets get tough. And that's where you'll find the opportunity. See, it's a long-term game. And I know a lot of people right now are looking for the quick returns, which, yes, there have been a lot of opportunities for those quick returns. We have seen a lot of stocks, a lot of cryptocurrencies, a lot of things that have given people a lot of huge returns, which is nice if you can win, but that's not always the case. But if you're willing to be comfortable with decent returns, you can end up with a lot of wealth instead of trying to chase the shiny big win.
So you're focused on long-term no matter what, which I find is really interesting. Certainly we hear a lot about short-term opportunities and active opportunities like that some people like to dabble in, but it is not for everybody. That much is true. You mentioned in that POOP acronym that obviously you're looking for times when the overselling is excessive. Are there any specific criteria or metrics that you look for when you're doing stock research or market research that tell you that we might be at that point where the overselling is excessive?
Well, I think you can just look around and see what the sentiment is. When all the news and traditional media is telling you that everybody's getting rich by buying this investment, whatever it is, Bitcoin, stocks, real estate, housing, it doesn't matter. You're in a bubble. When the media is talking about how your taxi driver, your Uber driver, your whatever person is making more money doing this quick and easy way to make money by buying this asset, and everybody starts dumping money into this asset, even if they don't know what they're doing. And when you start to hear people that are leveraging up to their eyeballs to buy this asset who have no idea what this thing is, you're in a bubble. Likewise, when now everybody's panicking, selling, everyone's losing money, the media is talking about how it's over for this asset. Is it the end for this asset? Everybody's losing money. Stay as far away as possible. You know that you're in an overselling environment. Now, what you have to decide is when this overselling is happening, is it a good asset or is it a bad asset? That's going to go into your research. And so now if we're talking about equities, if we're talking about stocks, it's very different when you're analyzing an individual company like, say, Sears or Hertz, as opposed to the S&P 500. And now you can just play the game however you want. Do you want to invest in the individual company? Do you want to invest in a broad basket fund? And so, in terms of criteria, I mean, you can look at the definitions that a bear market is, 20%. Correction territory is, 10%. But at the end of the day, market sentiment will tell you kind of what's going on.
You mentioned bubbles there, and I kind of want to pick on that a little bit there. We've seen incredible run-ups in some, particularly AI tech stocks, AI-related tech stocks and stuff like that. And then we saw them get absolutely hammered when that news of DeepSeek AI kind of hit the market, and it's this AI algorithm that China developed that is done for reportedly a fraction of the cost of some of the top models out there. And we saw, I think NVIDIA lost something like $500 billion in value or something crazy like that. I think some people would look at that and say, hey, maybe we're in a tech stock bubble again or something like that, maybe akin to the dot-com bubble in some cases. It could be the interpretation some people might have. But my question to you is, let's say you see the market and you get the sense that there's an asset class that's in a bubble right now. There is so much money that you could make riding that bubble to the top. Obviously, you just don't want to be on the wrong side of that thing. How do you navigate a situation like that, where like everyone around you seemingly is making money off this bubble? Do you engage with it? What do you do?
Well, we're always in some sort of bubble. Do I engage with it? Depends on what it is. I mean, if I see it as an opportunity, sure. The internet didn't go away after the internet bubble burst. It just shifted where the capital was. AI, is it a bubble? Of course. I mean, if NVIDIA stock is going to fall by 16% in one day out of rumors that this company out of China, is beating NVIDIA, and so people are assuming that NVIDIA is going to die all of a sudden. That's really all signs of a bubble. Does it mean it's a bad investment? No, not necessarily. It depends on how long your horizon is. And bubbles can make people a lot of money. The housing market bubble made people very rich. But the people that were holding the bag when the bubble burst lost a lot. Unless they held on, right? And so, if you bought a house, let's just say in 2005, let's just say you bought it for $300,000. Let's just put in some numbers in here. And then the housing market burst, and let's say that the house fell in value to $100,000. So, I mean, we're talking about a drastic drop in value, that your house lost 2/3 of its value. You might be devastated, but if you continue making the payments, or if you own it free and clear, it lost value, but okay, just say you hold on. Today, the house might be worth $600,000. So, if you have a good asset, you want to be holding on. And so, again, if you're investing in individual companies, you got to know the game, you got to know your goal. For me, my goal is cash flow. That is the bulk of my investments. That's why I like real estate, because real estate can give me cash flow. Most of my when my funds that I invest in are dividend paying, because I like that cash flow. And some of the companies that I invest in the stock market also for that cash flow. So, you got to know the game that you're playing and understand the risks that are associated with it. When you're looking for these fast growth, fast kind of moving like AI companies, your game is not cash flow. Your game is growth. I want to see my money grow very quickly. That's more risky. And it's part of the territory, it's part of the game. And you got to know what game you're playing, and depending on the game, you're going to have different types of outcomes.
Okay, I want to turn our attention to the future for a moment here, and specifically one near and dear to Canadians, certainly in the world, but near and dear to Canadians as well too, because there's a lot of mixed opinion on this new Trump administration, what it's going to mean for the U.S. economy, global stock markets. Certainly, like I said, for Canada, near and dear to us here, because tariffs are obviously a top concern for the Canadian economy, as it is for many other economies. How do you see things shaking out with that? And do you see an opportunity for a big wealth building opportunity coming here, depending on how things play out as the way you see it? How do you think about it?
Yeah, so I'll put it like this. Doesn't matter if you're a Republican, doesn't matter if you're a Democrat, I really don't care. What I like to do is talk about where the opportunity is. And the difference between Trump versus Harris is where they would have allocated money. What I mean by that is our United States economy, our GDP, is about roughly $30 trillion large. And the largest spender in the economy is the government. The government spends somewhere between $5-6 trillion out of our entire United States economy. So when you understand that, what you'll understand is that the person in power, the president, can then allocate where a big chunk of government spending goes. Those create investment opportunities. And that's really now the key. You said, is there wealth building opportunity? Absolutely. It wouldn't matter who's in office. There's always wealth building opportunities. The first wealth building opportunity is taking care of your own house, not worrying about what's happening in the White House. That means not spending all of your money, putting money aside to save, paying off those credit card bills, putting money aside to invest. Once you can take care of your own house in that way, now you understand how can you grow your house? How do you invest your money? Well, again, I don't care who's in the White House. I think investing in the economy, something like the S&P 500 for the long term is a good investment because, well, if I believe in the U.S. economy, so I believe that it's going to be a good long-term investment. If you don't do that. But then you can also look for more individualized opportunities. Well, what is Trump going to do? Trump has talked about doing a number of things, including tariffs. He's talked about deporting a lot of illegal immigrants. He's talked about investing in space. He's talked about doing a lot of different things. All of these things create an investment opportunity somewhere, and you have to understand where that thing is. And so, if you are interested in kind of playing that, let's call it Trump investment strategy of understanding where he's going to shift money, those create opportunities, absolutely. But it's not a Trump isolated thing. It's just whoever's in the White House gets to decide where some of the GDP goes, and you want to understand how can you invest based off of that.
Okay, so it's just being active and thinking about where those money shifts are going to happen, like you mentioned before. Are there any that jump out to you immediately that you have an eye on right now, just out of curiosity?
Well, I'll just kind of break it down in this way. When Trump talks about tariffs, what is the goal with tariffs? The goal with tariffs is to bring manufacturing back to the United States. That's the intention. If manufacturing comes back into the United States, let's go down that scenario, what does that mean? Well, that means that plants and manufacturing facilities will probably have to ship products between one place and the other more frequently because now that manufacturing is happening here. Who does that benefit? Well, that can benefit certain freight companies, certain railroad companies. Trump has talked about deporting millions of illegal immigrants. What does that mean? Who likes that? Well, private prisons like that. Why? Because those people now get arrested and have to go somewhere, which means more contracts, more money for private prisons. That's why when the day that Trump won the election, private prison stocks soared. Trump has talked about investing a lot into space exploration. Well, what does that mean? Well, if there's going to be more contracts for space exploration companies, they could be getting more government money. Trump has talked about expanding the military, strengthening the military. What does that mean? Well, the military is buying artillery, things like bullets, guns, tanks from private companies. Well, those defense companies are companies that you can invest in. Trump has talked about deregulating financial service companies, banks, hedge funds, things like that, which means in theory, they could have the potential to make more money. Trump has talked about deregulating oil and gas, which means in theory, those energy companies could also have the potential to see bigger revenues and bigger profits. So those are just a few of the things that he's talked about. Now, not every opportunity is going to be a good opportunity for you. What I like to say is a good opportunity has to make legal sense, meaning it's legal. It has to make financial sense, meaning you have the opportunity to make money. And then it has to make good moral sense for you. I'm not going to be a moral compass. I just want you to understand what's happening. That way you can be the judge of how you invest your money. Now you can start looking at a shift. And you can say, okay, well, if Trump is going to be deregulating financial services, that could benefit the banks on Wall Street. Does that mean every bank on Wall Street is going to benefit? No, not necessarily. One company could mismanage their company and run themselves to the ground, even though there's a shift into that industry. So it's that research followed by your own investment education of understanding how do you actually analyze the investment as well.
Okay, lots of tangible investment themes to kickstart research here as the Trump administration gets underway. Jaspreet, thanks for sharing those ideas with us, and also your mindset, this minority mindset that can help people think big picture and think about ways to make money that aren't as common out there. So really appreciate that. Yeah. We're not done with our conversation yet, though. Our conversation may be done, but we're going to go turn it over to our viewers now. Check out our live Q&A here. We've got a bunch of questions that we're going to take from viewers. Are you ready to hear what they want to know more about?
Yeah, let's do it. And I do want to mention that this is the research. I don't do it all myself. This is what my team does. So at Briefs Media, we have a pro newsletter called Market Briefs Pro where they cover these types of shifts.
Right, yeah, lots of great sources. I personally subscribe to admittedly your free newsletter, but I enjoy that one too. But certainly you can check out more of Jaspreet's stuff there in our resources section of our broadcast console. We have links to Briefs Media as well as his YouTube channel. So you can check out a lot of the stuff that he's doing as well if you're interested in learning more about him and the work that he does. Let's get to the question period here. We're going to start with a question from Angelica. And she's saying, with so many setbacks, how did you overcome fear when starting your content channel?
So I didn't really look at them as setbacks, number one. And number two, I didn't give myself another option. So I go back to think about this when I was starting my party promotion company when I was in college. The first party that I threw, I got completely screwed over. Club owners can be very difficult to deal with and very shady. And so I had planned this big party, and then the club got shut down the night before my event, which ended up being a huge mess, cost me a lot of money, and it was just a huge mess. But I don't know. I was a little bit naive and a little bit hard-headed, that I just didn't think that these things could stop me, that I'm just going to do it anyways. And I was very stubborn. So I think having a little bit of a hard head and a little bit of stubbornness helped me get through it, which was something that I really needed at the time. So I guess I was just really hard-headed, and I didn't take no for an answer.
Okay, stay committed. That's a great message there. Let's keep things rolling along the tracks here. We have another question coming to us from Joycelyn. She is asking, how can a beginner start in real estate investing today? Interesting question, considering the elevated cost of housing in a lot of markets. What's your take on that, Jaspreet?
Well, there's a lot more resources to start in real estate today than ever before. I'm not an advocate for you to go out and do no money down real estate. I think that's very risky. But there's a lot of ways to get exposure to real estate without actually buying a whole property itself. So go to real estate investor conferences in your area. They happen all over, everywhere. And anytime you go to one, you will see different ways to invest in real estate. And you will meet real estate investors and real estate developers who are always looking for money. And so you could potentially invest in these types of syndicate deals, which means you give them some money, they give you ownership of the property or piece of ownership in the property, and they do all the work. Now, before you just go and throw anybody money, learn about them, learn about the deal. If the deal looks exciting, then that's something that you can consider investing in. So yes, the real estate market is different today, but that doesn't mean that there's no opportunities today. I think a lot of people get caught up in that, oh, asset prices are high, so you can't start investing now. No, that's a horrible take. There's always opportunities. The opportunities are just shifting. They always shift. And you just have to find the new opportunities of today's time. And there's a lot out there.
Well, speaking of opportunity, actually, opportunity being the word here, Casey has a question on that, and they want to know what is considered a good opportunity, or what do you consider a good opportunity, specifically around what I'm taking here, the stock market. How much should you see the market be down that before it kind of signals to you that, hey, this is a great opportunity?
Well, everything is going to be different. So I'll break it down this way. When I invest in real estate, I'm looking for cash flow. A good opportunity for me is to see 7% cash on cash return. So if I invest $100, I want to see $7 of positive cash flow just from my rental property income profit after paying all my expenses for every $100 that I invest. In the stock market, now, when I look for opportunity, well, number one, remember I have a passive strategy. I just keep investing. If I see the markets are falling hard, if I see a market crash and everybody's talking about it, I'm going to increase how much money I'm putting into my passive investments. Now, when we talk about my active investments, now I want to I want to look for a good opportunity that I believe is going to be able to grow, and it's going to depend on the stage of the company. If this is a younger company, I want to see this company grow multiples of where they are. That way they can eventually become profitable to pay out a dividend. If they're more grown, then that might not be as exciting of an opportunity for me. And the reason why I say this is because a lot of times people will ask, what stock should I buy? Well, if you're asking what stock should I buy, you are playing the wrong game. Because a good stock or a good investment for me probably is not a good stock, a good investment for you. The reason is I have a different risk tolerance than you. I have a different time horizon than you. I have a different goal than you, and I have different needs than you. And so this is where, you just got to understand, what are you looking for? The markets on average have grown by 10% a year. Is that fair for you? Do a compound interest calculator online to see how much money you can invest and see if that's okay for you. If you're looking for higher returns, understand that comes with more risk. Understand that you should be investing more time. Understand that you should be investing more research. If you don't want to put in the time or research or effort or learning, then don't go out and do that. So you really just got to know yourself and know your game and know how much time and effort you're willing to put in. But start with understanding the baseline of the markets have grown by 10% a year. And if you're not happy with that, now you got to get more involved.
It certainly is about knowing yourself as an investor, no matter what kind of investor you are. One of the things that you can do if you're kind of curious about where you kind of fall on the spectrum, some people don't really appreciate, like, what is my actual risk tolerance? Take an investor survey, an investor questionnaire that will help you figure out what your goals are, your needs are, your risk tolerance, your time horizon, all that stuff. And that can kind of help orient you a little bit as you're coming across these investment opportunities. We're going to have a poll put up on screen. We got so many questions coming in, Jaspreet. Everybody wants to pick your brain about something. And unfortunately, we're not going to be able to get to them all. So we have a poll up on screen here. If you're joining us on the broadcast platform, please choose which ones you want Jaspreet to answer, and we'll take the top, let's call it 2 responses. And again, if you're joining us on our YouTube live stream, feel free to hop over in the link in the description. You can cast your vote for some of these questions as well and have your voice heard as well. While we wait for people's votes to trickle in here, we have another question coming in to us from Gregory. And Gregory wants to know, Jaspreet, would your strategy work for a retired person? What do you think about that?
Look, I can't tell you what to do, but the strategy of investing your money for the long term works. And investing is the same when you're 20 versus 40 versus 60 versus 70. It's just your time horizon. At the end of the day, there are 3 factors that will determine how wealthy you're going to become. And this is regardless of all factors. TRM, time, return, money. Those are the three things that will determine how wealthy you're going to become. Time is how much time your money can stay invested for. The more time you can invest your money, the wealthier you're going to become. This is the only factor that we cannot go back and change because we can't start investing 5 years ago. Return is how fast you can double your money. And this is going to depend on where you are putting your money. Are you investing your money into the S&P 500, or are you trying to find the next NVIDIA, Tesla, Amazon, Apple? Some of those are going to take more risk, right? If you're trying to find the next hot stock, it's going to be more risk, more potential return. Investing your money into the S&P 500, less risk, less potential return, but you just got to know what the numbers are. Then finally is M, money. The more money you invest, the more wealth that you can build. And so now you can just play with a compound interest calculator and see, depending on where you are, how much time that you have for your money to grow, what numbers make sense for you. If you say, I have 5 years to invest, well, now you got to take a look at the R and the M, the return and the money that you can invest to see what that looks like. And if there's not enough upside, then you have to work on the income. And so, you got to understand, investing is all about taking your extra money, and putting that to work so that your extra money can make you money over time when you're not working.
Maybe just a short follow-up, if I could get your take on this one. It's often debated how much money somebody should save and invest for retirement in the lead up to retirement. What do you think that magic number is for most people?
I don't know. I mean, it just depends. For some people, $1 million is enough for retirement. For somebody else, $10 million won't even scratch the surface of retirement. Look, I mean, if you want to fly in private jets and you want to travel the world, you're going to need a lot of money. And maybe $10 million is not enough. If we just say, I want to be financially free and I don't want to worry about things, maybe $1 million is enough. You got to know your lifestyle. If you say, you know what, I'm going to move to a country like Guatemala and I'm going to live off of $5,000 a month, you don't even need $1 million. It's just, you got to know what is right for you.
Really what I was getting at is, like, is there a percentage of, like, the paycheck, let's say? Should you be putting aside 10, 15, 20% more than that? What do you think? I know everybody's different, but as a general rule of thumb, is there a number you could throw out there?
I say 75, 15, 10. 10 cents out of every dollar that you earn should be saved. 15 cents out of every dollar that you earn needs to be invested. 75 cents out of every dollar that you earn is the maximum that you can spend, which means you are living off of 3/4 of every dollar that you earn. Once you hit your savings goal, you hit your emergency savings goal of saving 3 to 12 months worth of expenses, you stop saving and you invest that money. So now you are ultimately trying to invest 1/4 of every dollar that you earn as a minimum, because that way you can really become wealthy.
Okay, nice little rule of thumb there. Again, everybody's different, but I like the rule of thumb there that just help kind of orient people's thoughts on this. Let's take a look at the results of our poll here. What were the most popular questions here? Okay, so we have 35% of respondents want to know your answer to this question, Jaspreet. I have $50K saved up and afraid to invest as markets are at an all-time high. I need some advice on how to invest my savings. Thanks. What do you think about that, Jaspreet? What would you say?
I have $50,000, but I'm scared to invest because markets are at an all-time high. Well, you have two options. Either A, you don't invest it, you put it into a high-yield savings account until you see an opportunity, or B, what you can do in conjunction is you just drip that money into the markets. You dollar cost average it into the markets. You put it into a high-yield savings account that's earning you 3-4%, and then you put a little bit of money in every week. And then if you do see a market pullback, you just buy more. If not, you just still buying every single week. Because we ultimately don't know, right? I'm not here into prediction game. There's plenty of people doing that, but that's ultimately guessing. Financial opinions are like armpits. Everybody's got a couple and some stink more than others. Nobody knows what's going to happen tomorrow, next week, or next year. I mean, there's so many things that could happen. A pandemic could happen. A war could happen. I mean, there's so many things that could trigger a market crash. And so, you can either go all in or you can dollar cost average it in. If you see a good opportunity, then you can buy some. But I like to buy in phases. I don't want to go all in at one time in case there is a better buying opportunity.
Yeah, certainly dollar cost averaging is something that a lot of investors would probably feel, I guess, safer and more comfortable doing rather than lump summing it in. Although there are some interesting stats that, lump summing can actually work out a lot of the time. But ultimately, it's about what you can live with, you can sleep at night with. So that's certainly a consideration there. Jaspreet, maybe just a quick follow-up on my own here. Is it fair to say that any kind of economic or market forecast is something that you just generally disregard just because nobody knows the future?
Oh, yeah. Take everything with a grain of salt. They make for fun YouTube videos because sometimes I'll talk about, all right, this is what JP Morgan, this is what Wells Fargo, this is what Bank of America says for this year. This is what they said for the last 5 years. Here's where they were wrong. The Federal Reserve Bank said that inflation was going to be transitory. The Federal Reserve Bank said that there was going to be no housing market bubble or crash in the 2008 crash. People can say whatever they want. It's people's opinions, but at the end of the day, you just got to understand markets go up, markets go down. Nobody has a clue what's going to happen tomorrow. If they did, well, they'd probably be arrested for some reason or another. So just understand, nobody knows. And everybody's opinion, whether they're a random guy on YouTube like me or whatever, they're guessing if they're telling you what's going to happen. So you just have to protect yourself. That way you can win no matter what happens.
Right on. Well said. We're at the hour right now. I just want to ask you one more question from the poll, maybe squeak in another question if I could. Are you okay to hang on for another 5 minutes or so just to get a couple more questions in there?
Let's do it. Thank you, everybody, for the questions, support, and thank you for your time as well. So I do appreciate that.
Yeah, it's been fantastic. Lots of great questions coming in. So on that note, the other most popular question we had, second most popular, I should say, is what happens if you don't have time? Like, for example, people in their mid-60s, going back to that retiree question, how should they invest? What do you think are some things that they should think about as they're figuring out what works for them?
If you're in your 60s and you don't have time, it depends on what you need. Because I've seen people say, Jaspreet, I'm 65 years old. I'm living off of Social Security and I'm not making enough money. What do I do? Well, that's not really an investment question. It's how do I go on and earn some more money question. Because investing $100 is not going to give you what you're looking for. If you say, you know what, I'm 65 and I have $5 million in the bank, what do I do? I just want to create some extra income and I want to have assets that I can pass on to my kids. Well, now you have a whole array of options. You can talk to a financial advisor, but you can now invest in dividend paying funds. You can invest in some real estate. You could buy a business. You can buy a whole bunch of things and then have some proper estate planning in place. That way you can pass it down. So you got to know kind of which side of that question are you on. Is it more of how do I earn an income or how do I now pass down assets?
Yeah, lots to consider in retirement. Certainly, it really does depend on what ultimately you want to do with your money. Do you want to reduce it down to zero or do you want to leave a legacy? Lots to consider there. Bavleen has a question here asking, best financial advice you ever got that can help in every stage of the investing journey. So looking for like really big picture investing wisdom here. What would you say is the top thing that you've heard, Jaspreet?
It's probably going to go back to something that Warren Buffett says. I'll say a few things that he has said. Number one, never chase a stock. Number two, be fearful when others are greedy. Be greedy when others are fearful. And number three, don't invest in something you don't understand. I've been burned on that a few times.
Yeah, certainly if Warren Buffett won't invest in something because he doesn't understand it, I think we could all learn something from that too. He's got a pretty decent track record last time I checked. In any case, we're going to leave it there, Jaspreet. Thank you so much for taking the time, a couple extra minutes with us too there. Much appreciated. And thank you everybody for the fantastic questions coming in. Jaspreet, as we leave it there, any final thoughts you want to share with our viewers before we say goodbye?
Well, thank you again for the opportunity. Thank you everybody for watching and your time. It means the world to me that you spent all this time with us today. Last words is really just understand, remember, markets go up, markets go down. The goal is to build wealth over the long term. You can reduce your risk by investing for the long term, and you can reduce your risk by learning. It's very easy to get caught up in wanting to just copy and just blindly follow what somebody else does, but it's okay to ask questions. It's okay to think a little differently. And just understand, everything comes with risk. And when you invest your money, you want to invest money that you are okay losing. The goal is not to lose the money, but you don't want to invest money that you need to pay your bills next week. Investing is taking your extra money putting that to work. That way you can use that extra money to build you wealth, because that's how real wealth is built. Our economic system, hate it or love it, is designed to benefit investors. Most of us are not taught that. You want to become an investor, but the way you learn is by studying and by doing. And when you do, you will screw up. You will make mistakes. You will lose money. That's not when you stop, that's when you keep going, because it's a part of the process. Once you can get past the hurdle, now you're going to understand a lot more. You will see more opportunity and you'll be able to capitalize on more opportunities, but it takes time and it takes that sacrifice as well.
Yeah, certainly a fantastic summary. Definitely, it's always a learning journey as well as in your investing journey. It's never like a one-size-fits-all thing. Things are always changing, but keeping yourself in focus, I think, is a really great message to be sharing here and your unique needs. Thank you so much, Jaspreet, for taking the time. Thank you, everybody, for joining in. Make sure you check out those resources in the broadcast console here if you want to learn more about Jaspreet and the work that he does, as well as some other episodes that we've done that are kind of related to today's topic that you might find of interest. We've got a ton of content on our Instagram and our YouTube pages as well, TD Direct Investing there. There's links on the left-hand side of your page there as well. And we do the show every single week, so take a look at the upcoming events. If there's something that catches your interest, make sure to click on the link and register for that as well. Thank you, everybody, for joining in. Really appreciate you taking the time. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.